Well, good morning, everyone. My name is Chris Lopez, and I'll be one of the co-hosts for today's webinar. And today we'll be doing some deal analysis for multi-units around Denver. Now, we've got a few properties queued up to talk about, but please ask questions at any time throughout this webinar. We want questions. We want it to be interactive. So if you have a question, just go to the questions box in the GoToWebinar app, type it in there, and we will answer those throughout the webinar. So a little bit about me. I'm a realtor at Your Castle Real Estate, but before I became a realtor there, I actually spent a couple months as an apartment broker in Los Angeles, California. Now, full transparency, I didn't do any deals there. I literally had my license for about 2 weeks at this brokerage before I realized it was not the right fit for me. But I did learn a lot by being in that environment and I'll say dipping my toe in the water. And I learned enough to kind of potentially see some opportunities and know enough to ask the right questions so I could start understanding more important things. And something that I noticed while I was there is it seemed like, at least in the Los Angeles multi-unit market, that the units, 5 to 15 units were underserviced. And by that I mean, like, you know, most of the apartments we focused on our brokerage was 15 to 100 units. And the lead brokers there would just say anything below 50 units is a complete waste of time. Don't look at those properties. Don't email those guys. Don't even waste our database space with those 15 unit and less properties. They are a freaking waste of time. I even set up a few meetings with apartment owners of 9 or 10 units, and they'd say, hey, nice job, but it's a freaking 10 unit. Stop wasting your time, which blew my mind because I'm like, hey, you still make a couple points on a couple $1 million property, but whatever, that was their attitude. So on the other end of the spectrum, I saw a lot of the properties listed in this 5 to 15 unit range, or I shouldn't say a lot, but a good amount of them, they're listed by more like residential realtors, people that focused on single family homes, condos, and townhomes. And it sounded like they'd often be like the niece or the nephew of the property owner and kind of doing a favor, but the property would be grossly mispriced, underpriced, overpriced, and it seemed like a very interesting area where just there might be some opportunity, and it was really underserviced. So I always had on the back of my mind is, hey, as I get more into investing, I'm going to keep my eye on those types of properties. So that has led to some very interesting conversations between myself and Charles Roberts, who has both knowledge and experience in the multi-unit world. So a little bit about Charles. He's been an investor for over 20 years. He's been a realtor for over 12 years, and he's done like over 400 transactions, with the majority of those being for investors, with some of those also being multi-unit deals. Now, Charles is, I call him a rare combination in his personality because he's one of those guys that likes to be hands-on and still in the trenches. He's out there still showing properties, listing properties, closing deals, but he's also kind of in that big picture driver's seat as well with the big picture of the Denver market. In addition to actually, you know, still closing transactions, he's also the president of 3 real estate firms with over 800 agents. And last year he earned his CCIM designation, which I won't go into details of, but just understand it's a very, very big deal in the commercial world. And typically people get that when they're working with hedge funds and private equities, and we're talking big, big numbers, you know, into the 50 million plus up range. So very rare for someone like Charles to have that, but that's actually great for our benefit. So Charles, thank you for doing this webinar. I'm really looking forward to it, and I've got a list of questions asked you throughout. But thank you, and I'm going to turn it over to you so you can start jumping into the deals.
Great, thanks, Chris. So really excited about this. So the genesis of this webinar, I approached Chris a few weeks ago and said, you know, we're doing lots and lots of deals with our clients, and the last couple of years, it's been almost exclusively condos and townhomes. That's where we've seen the cap rates and the right set of circumstances for the types of investors we work with. But I do get questions on multi-units. I think there's some myths out there that I want to pop, and I just want to give you a ground floor, like, here's what I'm seeing. Let me show you what multi-units are doing, because you are, oh, I don't know, you might be an agent, you might be an investor, you might be a newbie investor, you might be a 20-year investor, who knows what you are, but everybody has a different perspective, and everybody wants something different out of their property. So I'm going to do the best I can in this short period of time to give you a couple of examples of properties that are currently on the market that are multi-units, and then maybe compare them to the other stuff we're getting to see, maybe this makes sense for you. Maybe you're an agent listening who should reach out, make some forward calls to your clients to say, you know what, there's some multi-units that might be of interest. Or maybe you're an investor that says, yeah, Charles, you've been talking about, condos a lot, but no, this fourplex makes sense to me. Or maybe it doesn't. So bear with me a couple of minutes, and I'm just going to show you a few properties that I pulled. Now, we pulled them from CoStar. CoStar is the commercial brokerage MLS, basically. It's a national system. It's very expensive. It's very, very thorough. And one of the advantages we have is we have access to CoStar. So all I'm going to do is start by showing you a few properties. And as Chris says all the time, ask questions, ask questions. We love it when we get sidetracked and we're answering the things you want to talk about and make it more interesting. So type in the box and go ahead and ask questions. So let me start with this one right here, 5236 West 5th Ave. This property is currently on the market, and you can see here, for example, built in 1980. It's a 9-unit, 2 floors. It's brick. You can see that. Let's pop down here and get some information on it. For example, what you have are 9 2-bedroom units averaging 657 square feet, and they're saying their current rents are $898 a month. And then we come down here and say, okay, this is cool. They're asking $1,075,000, which breaks down to about $119K per unit, and it's a 6.9 cap. So Chris, let me come back to you. You do a lot of this stuff. So when you hear 6.19 cap, what does that mean to you? What are you thinking?
Well, it makes me think of a lot of things. I mean, compared to the properties I saw in Los Angeles, that's an awesome cap rate. But compared to the properties we're seeing, like the condos and townhomes and around Denver, we could do better. We could do a point or two better. So it makes me want to look into more and understand the numbers.
And that's exactly right, and that's what I think too. We're typically getting, 7.5 caps for the types of stuff we're getting in the single condos and townhomes. And if you haven't taken our class on spreadsheets and cap rates, then you're a little bit puzzled about what I'm saying. But I want you to understand a lower cap rate means a lower monthly cash flow. That's kind of the way to interpret this. So let's jump in then to the cash flow spreadsheets. I built a really quick spreadsheet for myself just because I like looking at it this way, and pretty much just took their numbers so that we understand what's happening with this. This is the address. Oh, I'm sorry, I just pulled the wrong one. Oh, yeah, sorry. No, this is the right one. Ours only goes up to 4 units, so I just confused myself. But this is a 9-unit property, and they're asking $1,075,000. I added up all the rents, and it was $8,028 for the 9 units. I did a bunch of calculations here, all the stuff we talk about, taxes. One of the things you have to remember is that the taxes for commercial buildings and multi-units are much higher than the taxes for residential. So if you get a condo or townhome, your taxes, I mean, we're buying stuff for $200,000 with like $500 taxes. So that's one of the big differences. And then we just pop over to here and you see the 6.1 cap rate. So it's good to understand that the stuff you're learning, the spreadsheets that we use, you can use it for a single family, for a duplex, condo, townhome, 10-unit, whatever you want. And that's what you need to do to be able to compare properties. So this one was a, decent property, I suppose, but it's still for sale, so it's not like it's going anywhere too fast. Basic 9-unit for $1,075,000.
Hey, Charles, sorry, before you open back up that spreadsheet, I think there's a question here from Doug, and we can play around the numbers real fast. So Doug asked, does the estimated 6% cap rate include vacancy? With 9 units, there'll always probably be some vacancy, correct? So how does that play with the numbers? And maybe we can play around with them real fast.
Yeah, it definitely should. And as you can see here, I built a spreadsheet based on the little work I put into knowing this property. I just kind of backed into the 6.1. So if they're saying here that their cap rate is 6, the truth is, Doug, it's exactly the right question because I don't know. I don't know what they put into it. So one could say, well, Charles, is that really a 6.19 cap? And I would say, I don't know, garbage in, garbage out, good numbers in, good numbers out. So it completely depends on how they are creating their cap rate. That's the right question, and it's just one of the things you need to do. So when I see a 6.19 cap, I say, great, now let me go do my own numbers and figure it out. The answer is I actually don't know if they factored it in. I certainly factor it in always whenever I do my stuff.
But in the calculation of cap rate, since that's net operating income divided by purchase price, whatever vacancy factor you put in there, it does change the cap rate.
Right. So the worst case scenario would be that they didn't actually factor the vacancy rate in, and the cap rate's more like a 5.8, right? Like, I'm not accusing them of that at all. I'm assuming they're professionals and they didn't do that because the net operating income assumes, of course, that you don't have 100% occupancy. But the fact is, this number doesn't tell me that. So we just need to do our due diligence. That's the bottom line, is always do your due diligence. Don't take anything on faith. So I want to give you a little. Oh, sorry.
Actually, one more thing. So go at that very bottom line, that last sale. Charles, this is a great example about, was sold October of 2015, so 2 years ago, and you can see the prices paid for and the cap rate. Go into some details about how as the price changes, was that due to the cap rate?
Right. So they bought it for $915,000 2 years ago. Honestly, they may have done some improvements. They may not have. I mean, that's what the market's been doing. That's why these things are so expensive. I mean, they're walking away with, well, we'll see what they get, but it looks like a six figures for them, depending upon what they put into it. But what this implies is that they bought it for a lower price, meaning the cap rate and the cash flow is higher. Now they're selling it for a higher price, meaning a lower cap rate. So all things being equal, this is almost like a fix and flip. Maybe they bought it, they got it, distressed, or they added some value to it, and then they're trying to sell it at a lower cap than they bought it. And you as an investor and you as an agent should be thinking, I wonder if I can do that. Maybe you can. Evidently, that's what these people are hoping to do.
Could you take that 915 and just plug it into the purchase price of that spreadsheet you built? I'm curious to see, if we come out with the 7.5 cap from there, or if they increase the rents or something.
Good question. Okay, so 915,000, go to cash flow, and that's the 7.1 cap, and they said they got 7.56. So it approaches it. This would be a bunch of information I'd want to get from them. I'd want to know, what work has been done recently. So this is just the tip of the iceberg in terms of looking at data. And one can only hope it's as accurate as it can be. But of course, we're not naive. Nobody's naive. Do your due diligence or do something else for a living. Okay, we good on this?
Yes.
Okay, so I was telling Chris about this a couple days ago. So no coincidence, I do a lot of deals, and a couple of years ago we bought a property. My client bought a property. Let me actually show you. Sorry, let me show you this one first. Bought a property very similar, just a couple of blocks away. We bought 5340 West 3rd Place. Let me open this up a little bit. Just a couple of blocks away, and it looked a lot like it. These were garden level units, but you can see brick. Similar, and we paid $570 for it, just so you know. It was 10 units instead of 9, and the average square footage was almost exactly the same, 786. It was really similar. We had to do some work to it, but it was a good deal. My guy Eric bought it, and this, I want to talk about this for a second, because this is what's going on in this market. For the good or the bad, love it or hate it, Eric bought this thing for $570,000. He's probably made $500,000 just on capital gains, never mind cash flow on this property. He bought it in April of 2013. He bought at the right time. It was not even at the bottom, honestly. It was we were having the same discussions in 2013. Ooh, what's going to happen? The market's gone up for 2 or 3 years. Is it going to fall apart? Well, it hasn't, and he made $500,000. For people who are listening right now, what I want you to hear is this is kind of why we're not buying too many of these, because the prices have gone up so high, so fast, the rents haven't kept up, therefore the cap rates are in the 5s and 6s often, and we're getting stuff in the 7s, and I've got one under contract in the 8s right now. So depending upon where you stand, this may be a good thing or a bad thing, but it explains to me why when I bought another round of properties about a year ago, I didn't buy these units because I wanted a higher cap rate. That's the bottom line. And let me do one quick one, and then I'll get to the question. He bought another one just a few months later, literally across the street. I mean, I could literally throw a rock from one to the other, same location on 3rd Place. We paid, I think, $280 for it. This was a 4-plex. And, God love him. Bought it from my buddy Brad Ulig, who's a great listing broker. So we've been buying these for a while, but we were buying much more in 09, 10, 11, 12. Kind of started tailing off in 13 and 14, and pretty much haven't been buying too many since then because of the cap rates.
What were the cap rates like? Do you remember what the cap rates were like back then?
As a matter of fact, I do. I looked on this one. This was an 8.6 cap. Believe it or not. Yeah, it was a good deal. Good for Eric for buying it.
So Arthur has a comment question here referring back to that first property. He says, I would think the sales price 2 years ago at $915K would have lower rents. I believe rents should increase about 5% over 2 years, but rents may not be at market. And yeah, you kind of answered your own question somewhat. You're assuming the landlord raise the rents to market every year. Sometimes they do, sometimes they don't. A lot of times landlords get a little lazy because they're making such great cash flow, or they don't have the right personality for it, and the rents may not be to market.
Right, so we just don't know at this point because we haven't done the research. I would have guessed they did raise the rents, but actually you're leading the witness because I'm going to show you the pro forma that they put together for this. But one thing to note is that you say, I believe rents should increase 5% in the last 2 years. The fact is rents have gone up about 20% across Metro Denver in the past 2 years. Crazy numbers, but they're up about 40% in the past 4 years. They've slackened a little bit, so in the last, we're sort of on a 6 to 7% per annum trajectory right now, but the fact is in the last 2 years they're up almost 20%. So yeah, I would have thought the rents went up. So let's look at the pro forma that Chris sent me because this is really instructive. So this is like the pretty sheet that they put together that actually has a lot more information and addresses kind of what you just talked about. So here they have, okay.
Sorry, first, what is a pro forma, Charles?
A pro forma is what would everything look like if we actually came to market? Somebody who knows Latin, tell me what pro forma means, but what it means to me is, what are market rents? What's a market situation versus what Arthur was just, oh, hey Art, I didn't realize it was you, what Art was just asking about. That's historical and that's today. So if you're renting it for $898 today, then the current would be $898 per unit. But if you think you can get $1,000 a unit, then you'd put the pro forma in. So somebody tell me why that this would be. I mean, okay, I understand they did some upgrades, but that's a really odd picture. Anyhow, moving on. What you see here is that they're all 2-bedroom, 1-bath, 9 units, and what they're saying is their pro forma rent is $1050. So Art, I know you got some of these, and anybody else, pop in if you think that a 2-bedroom, 1-bath, 800 square foot in Lakewood. Now this is not luxury Lakewood. This is condo. This is like 4-plex, 10-plex Lakewood. Do you think that's reasonable? Personally, I actually think it is. I haven't done any particular research, but I do this all day, every day. I actually think 1050 is pretty reasonable, and that's where it starts to get interesting, because we come down here and then we look at their cap rate existing. They're saying it's 6.19, but if they just raised the darn rents, the cap rate would be 7.46, and that becomes a very interesting property. And can I say Matt Alcorn, pro forma, a Latin term, literally means for the sake of form or as a matter of form. Thanks, Matt. I don't really know what that means, but basically what we mean by pro forma is this is their best estimate of today's rents. And I will keep that, Matt, because I didn't know what that meant. So the bottom line here is, when Chris sent this to me, I said, wow, well, we actually have to show this too, because this does become somewhat interesting at a 7.5 cap. To me, it actually is. And Art says rents are probably not at market. I agree. So market rents would show a higher current cap rate. Exactly. And the pro forma is telling us that at market rents, if we agreed it's 1050, that this is a pretty decent multi-unit. Even though the prices have skyrocketed so much, the rents have skyrocketed as well.
So can you scroll up just a little bit on that data sheet, Charles, before you close out? So we can have that operating data in the window. So something I actually wanted to ask you on, because I know in my brief stint as a multifamily guy in LA, their rule of thumb, that percent, that second, the bottom line, that percent of effective gross income, they always estimated 35% as the expenses to include everything, just the general rule of thumb to include everything. That seems awfully low to me. Again, from my limited experience, do you have a realistic? Is there a realistic number, or is that
No, you
too
were in LA.
optimistic?
So in LA, you were getting 4 and 5 caps, and that
Yeah.
actually would equate to a 35% of effective gross income. The numbers actually work perfectly. So if you want a 4 cap, you're dealing with tougher numbers, and one of the ways you can say the numbers were tougher is instead of 25% of effective gross income, your expenses were 35. You guys have unbelievable taxes and earthquake insurance or whatever. So it actually makes a lot of sense. Different markets are completely different. If we're in St. Louis, this is probably 20%, and we're probably looking at a 12 cap, 13 cap, something like that. And that's you as an agent or you as an investor listening, these are the decisions you need to make. Do I want to get a 4 cap in LA? Do I want to get a 12 cap in St. Louis? Do I want to get a 7.5 cap in Denver? The answer is, I don't know. It's whatever you want.
And what about for estimated maintenance and repairs? I mean, I'm assuming, there's no HOA on here, so you buy it, you have to replace the roof at some point, you have to do other stuff.
So back
Is there
to
a
you,
typical rule of thumb for multi-units here?
I put 9,000 right here per year. We like to say something like maybe 5% of gross rent. It totally depends. It really does. It's a great question, Chris, and I don't have a particular answer, but to the extent you want to be conservative, put more money away. To the extent you want to be optimistic, put less money. But to answer your question, I literally in line 45 of the spreadsheet put $9,000 that you're putting away per year. And you might say that's too little. Great. Then put it to 12,000 and then your cap rate drops, but you feel better about the property, whatever makes sense to you. We have a question here from Doug. Hey Doug, with a condo, a lot of big ticket items are covered in the HOA. It seems like with the multi-unit, you as the owner are the HOA. How concerned do you have to be with estimating capital improvements like roof, new heaters, and new water heaters? Exactly what Chris just said. So, Doug, if you don't mind, I'm going to mention that you just bought a, just a really solid, low sevens, decent property, Aurora South, just a little townhome condo kind of thing. So you're exactly right. While people can deride HOAs, the fact is they do provide some value, and sometimes they provide a lot of value, and sometimes they suck. So with a single family or a duplex or a tenplex, you're clearly going to put away more money, you should at least in the financial statement, put it away for heaters and stuff like that, because you're going to be responsible for more. The answer is, though, it's hard to put a number on it. The first bunch of properties I bought were duplexes, so I've owned little multi-units for a long time. I got to tell you, Doug, I'll show you my numbers. You would not believe how little money I've put into the duplexes I bought in '98 and '99, because I have all the records. I've put almost nothing in, and I'm making great cash flow, and I've paid them off. So I don't know, yeah, more. You have to put more money into these for roofs and stuff than condos, no question, but it's very difficult. It is not an exact science. I can't give you the number. There's no such number. Matt asked, what is the lowest cap rate you consider a good deal to have? Matt, it's a good question. My little high horse is it's not me, it's my buyers that have to decide if it's a finger quote good deal. But I will tell you, if we sat down and I showed you the last 30 deals that I closed from my buyers, they would range from about a 7.1, 7.2 cap up to, I don't know, Kyle got like an 8.8, 8.9 by adding a simple wall to a property for a few $1,000s. So 7 to 9 is what we've been buying. The bulk of them have been in the low to mid 7s in the last year. So I guess I would answer your question that in this market, for a property in a reasonably nice complex, not the worst areas, that's ready to go, my buyers just tend to be not fixing stuff up too much, we've been getting low to mid caps. That's the first way I can answer it. If you said, look, I got to have an 8 cap, well great, I'm closing on an 8 cap tomorrow, and I closed on one last week. And again, call me, I'll tell you where they are. I don't want to hide this stuff, one was Florida and the other one was South Sheridan. But they were, a little tougher neighborhoods, and it completely depends on what the clients want. And that's why you're here.
Oh, sorry, I was going to say, just to give you a different perspective. So when I was in LA, people would have bidding wars for properties at 3.5 caps. And to them, that was a great deal. I saw the craziest purchase in my mind, someone bought, it was like a $15 million apartment building for a 2.8 cap. Now, most people say that's crazy, but this guy also owned like 700 units around town. He was a pretty savvy investor. So a lot of it's just perspective.
Right, you go to Kansas City, you're snuffing your nose at a 14 cap. I'm like, oh, I'm not an idiot. I don't want a 14 cap. I want an 18 cap. Okay, great. Go get an 18 cap. Depends on a lot of things. Art, on larger properties, you can do a reserve analysis done by experts to tell you how much you should have in reserve. Art, go ahead and do that. I'd love to see you do it. You're absolutely right on like HOA type that you want to have a reserve account, and there are experts. We actually have a guy in your castle who's a very, very experienced HOA guy and investor who taught me all about reserve studies a number of years ago. But I've never seen anybody do it for a duplex or a fourplex or even a 10 or 12. All right, come back if you've actually heard that. I imagine it's very high. I'd love to see the number, but I don't know. I don't know that it's particularly scientific. I mean, I don't know. Get back to me and let me know. But I've seen a lot of reserve studies, of course, for larger HOAs. That's part of their due diligence for sure. Thank you for that. Oh wait, Art says I've done it for an 8 unit, but it was HOA related. Definitely, Art man. I'd want a 9 unit. He says, please let me know. I'd love to hear more about this. This is great. And then Doug says, how difficult is it to manage a 10 unit property? I'd imagine there are a lot of phone calls that come with it. Yeah, it's a lot like managing 10 units. I mean, yes, you have 10 tenants. You know, Doug, as you and I have talked about a lot, you just bought your first rental. It's great. You're going to buy it, pay it off. I mean, guess what? We get paid enormous amounts of money to deal with some unpleasant phone calls. The question is it harder to deal with a 10 unit than, say, 10 of the townhomes you bought? I don't know. I don't have a real answer. I think most people who've never done this say it's easier to deal with one property. I just don't have an answer to that, but in my experience, I just don't think it's that simple.
So Charles, I got a question for you. Is there like a
hold on. Hang on one second. So Travis says 1 roof versus 10 roofs. I hear you, Travis. I get that all the time. What if the 1 roof is 20 times more expensive because it's a commercial roof than each of the 10 other roofs, you know? Or if you buy a condo or townhome, you're not paying for it, the HOA is. Like, I totally get what you're saying, is that it may be easier to have 1 heater, 1 building, 1 roof. Just, I have to tell you, my 20 years of experience haven't really proven that to me. And not to say I'm trying to knock down multi-units. I'm not. I've done a lot of this. And for the right investor, it makes great sense. And maybe for you, thinking logically, 1 roof is better, but I actually want to look at the numbers and understand out of a cap rate or a cash on cash or an internal rate of return, I'm more interested in analyzing it that way. So definitely, I'm glad you brought that up. And if you ever want to chat more about this, this is the type of stuff that gets me up in the morning. Chris, sorry to interrupt.
Oh, that's fine. I was curious, is there a Colorado or Denver law that requires, you know, once there's so many units, you're required to have an on-site property manager or like a live-on property manager?
No, I'm not an attorney. Anybody correct me if I'm wrong. And we thank you for being on, by the way. We get tons of people on this webinar. But no, I'm certain to 1 step short of virtually certain that the answer is no.
Interesting. Okay. Because in California, if you had 16 or more units, you have to have an on-site property manager.
Well, that's why you're the left coast. You know, that's why everybody's leaving and coming to Colorado.
Exactly.
Yeah. Let's hit another question or two here. Irene, good morning. Cap rate, does it take into consideration the loan carrying costs, so it heavily depends on what you put down? Great question. Cap rate very specifically does not take into consideration the loan, exactly so that we take that variable out of the comparison. So call me if you want to talk more about this, but the whole point of a cap rate is you're comparing properties and not bringing in the variable of the loan, as opposed to internal rate of return or cash flow, which would take into consideration the loan and the terms. And one more question, Doug, thanks. Was just curious, if it was less work for the lower cap rate, which might kind of make sense. 6 cap doesn't sound bad, but you can make that in some totally passive investments too. And I'm with you, man. I mean, it's exactly what we talk about, is there's no perfect answer to this. If your life was going to be much simpler and easier with a 6 cap versus a 7 cap, and that was the only difference, you know, I mean, yeah, then maybe you'd say I'll take a little less money per month and have a simpler life. And that's That is the game, the fun thing about analyzing these properties, because the numbers take you just so far. And then you have to say, well, 10 roofs versus one roof, one location versus 10 locations. Ooh, you know, it all depends. And obviously some really smart people are buying these. My guy Eric bought the 9-unit and the 4-unit, and between the two, he's probably made maybe $750,000 since 2013. Okay, his timing was good, but hey, it was only 4 years ago, and he said the same thing. Should I buy these? I'm like, I don't know. Denver's pretty strong. Maybe you should. So there it is. And another question, what kind of loan do you need for a multi-unit commercial property? Is there any difference between the loan you would get for a condo? Yes, actually. So above 4 units, meaning starting at 5, you need a commercial loan, portfolio loan, you know, Bank of the West, Guarantee Bank, First Bank, that kind of loan. I believe what you got on yours, Doug, was a Fannie Mae, Freddie Mac agency product, putting 20% down. I think you got a 30-year fixed, something like that, and that was just a normal standard loan. So yes, one of the big differences is that you have to get a commercial loan, but that's a whole other topic we could actually have. But commercial loans they're great loans, and they're not expensive. They probably won't be fully amortized 15 or 30-year loans, but you can get a 5/1, 7/1 ARM, you know, and I mean, they're not overly expensive. There are some expenses. The appraisals are much more expensive. The inspections are much more expensive. Just a whole bunch of different things that you factor, put into a spreadsheet, and then you've got about 30% of the answer, and then you got to figure out, you know, what you want to buy.
And something that an interesting thing I noticed a lot of people, investors did in LA, was that commercial loans, you can do interest-only loans. So they would do an interest-only loan for, you know, 2 or 3 year period, and they would come in and they'd be able to fix up the unit, raise the rents, and get the, you know, increase the rents on the apartment building, then refinance it, and then go into a more traditional 5-year, 7-year ARM where they're paying primary, or, you know, paying principal and interest. So very, I'll say, more creative financing, where they can do that because the numbers would work and allow them to come in here and buy a 30-unit property, fix it up, and just make some amazing cash flow. That current cash flow will cover the interest payments, and then go from there. Really interesting stuff.
Yeah, and that's kind of what Eric did, you know, on these simple little 4 and 10-unit properties. I mean, he bought them, he put some money into them. I can't remember how much, but I think the 10-unit, there was some work to be done. You know, I'm guessing he put 50, 70,000 into it, something like that. But he raised the value as well as ridden the upturn in our market. Did get a question, can you do an FHA for a 4+ unit? No, definitely not for a 4+. Absolutely, positively not. Chris, before I jump into the next one, slow me down a little. Any questions you have or any things that we should be talking about?
No, we're good. Let's dive into deal number 2.
Okay, so that first one was in Lakewood. You know, it's Lakewood, but it feels a little Denver Southwesty. You know, not, I mean, these are not, how do I put it? You know, like, these aren't luxury neighborhoods. These are neighborhoods that have lots of 4-plexes and 10-plexes on them. Terrific rental neighborhoods. And obviously you see that if you do everything right and get lucky, like Eric has, you can make a lot of money. You can lose money there too. I thought on the other end, I would show you another property from the CoStar report. This one is at 2721 Madison Street. It's in Skyland, another area of town that has just boomed a lot and just gotten a lot nicer. We were looking, I was buying in Skyland 15, 18 years ago, and it wasn't what it is today. So this is a low-rise apartment, and let's go down and look at it a little more closely. So you see here, what you have is it's a 5-unit property. It's got 5 units, and they're huge. The average square foot is 1,350, which to me, if I had all that square footage, I would have had, like, you know, maybe 900 square foot. Like, there's no question your cash flow is going to be better, but there's probably nothing you can do about it. This is what it is. 5 units. The average per unit price currently is $1,431. Now, they're only 2-bedroom units, and that's a pretty high number. I can tell you you're not going to get Section 8 there because that's too high. So I can only assume they're not lying, that this is actual rents. And this is, they clearly have done some work to it. They made the outside look really nice. They're enormous units. So yeah, I mean, 1431, my guess is these are crazy days. That's what they're getting for rent. And when we come down, we look at the price and the numbers. They're asking $1.3 million, and it's a 5 cap. So you take a step back and you go, okay, well, the guys that Chris was talking about in LA were, you know, I mean, someone bought it at 2.5 cap, but this guy's got billions of dollars. He knows what he's doing, and it was the right product for him. Somebody is going to buy this property at some point. It is remarkable, though, to look at this. Someone bought this thing a couple of years ago and paid $700,000. Now, looking at the outside, I don't have all the pictures here. Obviously, I can get that for you if you're interested, but it looks like they probably did a lot of work to it. You know, I mean, that's beautiful. Look at that. I mean, it's kind of gorgeous. I mean, how much could they possibly have put in? A couple $100,000? So these guys are looking at potentially walking away with a lot of money, but of course, it's not under contract, so we'll see what they get. But I just wanted to give you.
It is under contract. Sorry.
Sorry?
Right. Look to the right. Doesn't that say under contract?
Oh my God. All right. I almost said a bad word. I shouldn't have. I didn't even notice that, Chris. Okay, so one more time, we don't know what it's under contract for, but yes, thank you for pointing out this is under contract. And I'll tell you, know, just because you're new and baffled by this, you can be doing this for 10 or 20 or 30 years and still be baffled by this, that someone could have bought this thing for $700 2 years ago and be under contract, maybe in this range. Wow. Thanks for pointing that out. I didn't notice.
Now, one of the, and this might be an interesting discussion, Charles, because this is where, I mean, to kind of, I'll say, force that appreciation, I mean, that's almost doubling the price of the multi-unit. That typically doesn't come from just the market, you know, the rising market lifting all ships. That's probably because they came in, picked up the property, and raised the rents. That's typically the biggest factor in appreciation for multifamily, or is that not the case?
Well, it just depends. So, I mean, let me give you 2 examples. You could have bought a fourplex 2 years ago and done nothing, and the rents have gone up about 20%. Or you could have bought a fourplex, you know, 10 years ago or something, and in 2 years the rent didn't go up at all, but you did exactly what you just said. You made improvements and you got 20% more rent. In this case, I think they did both. For these numbers to be the case, because if you look at it, a 6.2 cap and a 5 cap are really similar, and yet the price is up 80%. Clearly, they did a lot of work. I mean, they just had to have. The rents were probably $800 2 years ago. They got a bump in 15 or 20% in market rents, and they probably got a bump of 15 to 20% because they probably put 100 or 200,000 into it. That is my best guess, and I'd be willing to bet a quarter that this is a result of both the market being in their favor and they're putting a lot of work into this property. Other questions, thoughts, Chris? Anywhere direction that I should take this? And any other questions? Keep on giving me questions. I love them.
Just a general question for multi-units out there. Are there sections of Denver surrounding towns with rent control multi-units? Because in LA, that's a big issue. Is rent control common in Denver?
Yeah, it's not common in Denver. We've looked into this a lot, and there has been legislation. I actually got Pat, who's an attorney and an agent with us, to do some research for me. There has been legislation. I don't think Boulder has it. Someone correct me if I'm wrong, but I don't think they have actually passed it yet. Rent control is a very, very complicated topic. So basically, if you're on the political left, you think it's the best thing ever. If you're on the political right, you think it's the worst thing ever. And the answer, of course, like everything else, is neither is absolutely correct. I can make a case for both, but you know, as a reasonably liberal person who owns lots of property, so I have kind of a foot in both doors, I actually think rent control does not do what people think rent control does. In the end, what you see is rent control drives investors out of a market, which reduces the supply, which screws the tenants. So it looks good, sounds good for a couple of years. It might actually help some tenants, but in the end, you know, we tried communism. We didn't think it was the right thing for us. So I'm not a big rent control fan, and we don't see it a lot in our market.
So another question here from Heidi. So Charles, can you do a 1031 exchange from a single-family home to, say, a 9-unit multi-apartment building? Is that considered a like property?
Indeed it is, as long as the single-family home was not owner-occupied. So a like-kind property, man, you can do so many different things. And if you want some more information on 1031s, let me know. Happy to chat. Can refer you to Chris Sayer and others. I'm closing tomorrow. I'm closing on a 1031 investor buying some property. The answer is yes. If the single-family home was a rental, then you should be able to, no problem, call it a like-kind property and buy a 9-unit and back and forth all over the place. Lots and lots of things you can do with 1031s, and we do lots of them. We like 1031s. It's interesting because all the 1031 companies went out of business in like 2009 and 2010. Why? Because no investors had any equity in their property. It was brutal for these folks. Now they are high on the hog because everybody who took a chance, who held their properties, who made it through the downturn, who bought some properties when everybody told them not to, now has millions of dollars, and the 1031 companies are cranking it. Got a question here. Let me read it because it's long. So it looks like in a lot of the examples we've seen, investors have bought the multi-units to fix them up, increase rents, and flip them. Are they purchasing them for more appreciation than the long-term buy and the whole cash flow, or maybe the appreciation that the market generated made it worthwhile to sell now rather than hold? And the answer is I don't know. You know, obviously I don't know. It does appear, and I think it's somewhat by coincidence, that a couple of these were purchased recently. But remember, my guy Eric bought his in 13 and he's not selling. And you know me, you know I'm not selling. So I think it's a coincidence. I'm thinking that a couple of them that we showed actually were almost like fix and flips. But there's nothing wrong with that. I mean, they're going to make a ton of money, and maybe they're going to buy other properties in this market, or they're going to diversify into the S&P, or they're going to buy in LA. Who knows what they're going to do? Like, once you have the money, it's a great problem to have. So I can't say what people are going to do with it, and I can tell you really smart people sometimes make a lot of money with fix and flips and sometimes lose money in fix and flips, and really smart people sometimes make a lot of money with buy and holds, and sometimes they screw it up and lose. It's about the business plan and the ability to actually execute it. So I don't know what these folks are doing, but whatever they've done, these two seem to have done something right. Chris, any other questions or anything we want to talk about now?
No, I would say let's jump on the spreadsheet for this.
Okay. So I'm going to open up the spreadsheet and just basically show you the numbers that I pulled off our simple little spreadsheet. That's the property. That's 1.3 million. I put in the asking price because I don't know, you know, what it actually went under contract for. I put in the rents, which are right here. Make this a little bit bigger. I do have my vacancy factor, annual rent appreciation, annual price appreciation, taxes, etc., repairs and maintenance, put all the stuff in, and I came out, you know, with this 5.1 cap. So it's a relatively low cap, but one can make money in real estate in many, many different ways. And for someone to say it's dumb to buy a 5.1 cap, I would never say that. I would say if that's the right property for you, if it provides more security, if it's less maintenance, if one roof versus 10 roofs, you know, that was brought up earlier, like whatever's right for you. So you don't buy at a cap rate. If you did, you'd all be buying in Detroit right now. Maybe you should, maybe you shouldn't, but you can get your 15 to 18 caps there. You got to figure out what's right for you. When I looked a couple of years ago at buying some more properties, I made the decision that I did not find a 5.1 cap acceptable. And part of that is because I have so many years of management that I'm like, I'm comfortable with my tenants. I can deal with it. I'm okay with it. I've gotten better, you know, 2 steps forward, 1 step back. I wanted the higher cap rates. I didn't want to get commercial. And there was nothing about, you know, having all my units in one place that made me jump up and down to take a lesser cap. But that's just me. It doesn't mean that should be you. And clearly, there are thousands and thousands of very rich investors who have bought multi-units around the country over the years. You know, that's why you're here, to see if this would make sense for you or your clients.
So, Charles, I know we're getting towards the end of the hour. And at one point, I would like you to do a comparison just for kind of apples to oranges sake. You are, I think, closing or about to close on a property with a client that, you know, says a very typical condo out there that you can buy. Do you have time to do a quick comparison for that before we do property number 3?
Yeah, and actually I'm thinking let's not do property number 3 and just take any more questions. The third property, like, I don't know that there's marginal value to adding that one, so give us a couple more minutes to have these type of discussions. So the one I'm buying, let's see, that's, okay, that is on East Florida. is the one we're closing. That's a 1031. My client bought a property in Virginia a few years ago, made some money, came to me and said, hey, let's invest this. He had about, what was it, 400,000 if I remember correctly. Chris Sayer from 1031X, who's my client, well, my colleague, and one of my agents owns a great 1031 company and also a tennis partner of mine. He's doing the 1031 and pretty simple deals. We did exactly this analysis. When he came to me about 2 months ago, he was referred to me by his brother, who's a client of mine. He said, Charles, we want to buy some duplexes or triplexes. I said, great, let's go look at some. We went to Aurora North. He said, never, ever take me here again. I'm like, okay, whatever you want. I own property here. I like Aurora North. He was not comfortable with that neighborhood. He made it very clear. I said, terrific. This is the learning process. You're a super smart guy. You make tons of money for a national accounting firm. You got to go see property before you know what you're talking about. We literally looked at 4 or 5 properties. He said, this is not what I want. So we ended up buying, we have 2 under contract. We're closing 1 tomorrow. That one is East Florida. And if I remember correctly, it's like an 8.2 or an 8.4 cap. Actually, you know what, I hate to use my memory because it's not good. I don't think I'm giving anything away if I actually tell you what the property is. So,
we had the one pulled up on Utah. Is that the one you're talking about, or are you on a different one?
You know what? I'm sorry. We're closing Florida in a couple of weeks, and Utah. Sorry, we are closing Utah.
Okay.
So this is the Utah circle. Let's see if I actually ran the numbers on it. Yeah, right here. So this is, I love this property. It's a 3-bedroom, 3-bath. We're paying $200 for it. We think rent's very solid, $1,750, and maybe more. I actually think that's pretty conservative. This place is nice. Go check it out. Taxes were $950, property insurance $250. We put that in for repairs and maintenance. Wild ass guess, but that's what we put. HOA is pretty under control. And then if you look at the numbers, it's a 7.7, and this place is ready to go. I mean, this was just a solid, like somewhere between a single and a double. Like my 7.1, 7.2s are the solid singles. This one was pretty good. We liked this property. We looked at a bunch. This one made sense for him. 7.7 cap. It just it was the right property for him, so it's what we bought. So again, like what I'm trying to do is tell people, don't walk in and say multi-unit's the right answer or condos is the right answer. You read a book on single families and nice neighborhoods, you're led to believe that's the right answer. It's more complicated than that. The right answer is what's right for you. So as an agent, I teach my agents, like, go the extra mile. Don't do the easy thing and just agree with what the client says. Like, you want a client for life. Challenge them. Get them into the right thing. And as a buyer, when I was a buyer, again, I bought another round of properties, I asked myself the same question. I went and got my CCIM to understand the darn commercial world. And that was hard. And I decided I don't want to own commercial real estate. Like, that's how deep I dove into this to figure out what's right for me. You, as a client, needs to find out what's right for you. You need to work with the right person and the right team that they challenge you and show you and help you decide what's right for you. And that's what's so fascinating, what's endlessly fascinating about investing in real estate.
So there's a great question now for you, Charles, from Art, and I'll read it. So Art says he is currently looking for a multi-unit, 4 units or less, so he can get conventional financing. And he sees multi-units don't necessarily have higher cap rates, but by the virtue of being a multi-unit, they cash flow more, or they have the potential to. Do you have an example showing evidence, in your opinion, that single-family residences can cash flow more with the same amount of money invested?
Yeah, I do, Art. And so Art and I work together a lot. And it's beyond the scope of this, but let's talk about it or let's sit down. So what I'm saying is, first of all, you say single-family residence. Now, let's be careful there, because I actually am finding that single-family detached homes are not cash flowing great either. So 3 or 4 years ago, 90 to 95% of what my buyers bought for cash flow properties were single-family homes and multi-units. And in the last couple of years, 95% have been attached condos or townhomes. So what I'm saying is that by and large, you know, you're out there looking, I'm out there looking. My analysis has been, we've been buying the condos attached because they've been overall better cash flow, in better condition, in better parts of town. And that's exactly what this webinar is about. is to talk about the pros and cons. And I know you've been buying the fourplexes and building up your portfolio, and let's challenge each other with this. But, you know, I had some money, I just bought some properties, and I didn't want to buy a fourplex for me. For you, it might make sense, but I think I can definitely say that, in my opinion, cash flows, by and large, for similar quality properties in similar neighborhoods, I have been finding better cash flows with the condos and the townhomes than the fourplexes. Yeah, and the irony, you know, the joke is, I'm a real estate agent. I want people to go buy $600,000 properties because I make more money, right? But instead, I got to sell them 3 or 4 properties. If that's the right thing for them, that's what I'm going to do. Other clients say, no, Charles, this $600,000 triplex makes sense for me. Awesome. Let's go and get that property for you. But let's have that discussion so that you never second guess yourself.
So would there be any value in doing an exercise of where you've got this 5-unit up here for $1.3 million, and then I know it's probably a little higher than what Art was looking at, but take the cash flow of that Utah property, multiply it by times 5. I mean, would that be a worthwhile exercise to see how much money is invested in cash flow, or is that just totally a pointless exercise?
No, it's not pointless, but it's just much easier. Like, just do spreadsheets for both of them, and then look at any metric you want. Look at your 5-year internal rate of return. Look at your monthly cash flow. Look at your cap rate. I mean, that's the great power of spreadsheets, is that you put in numbers, and to the extent those numbers are correct, then you're going to see the difference in the returns. But someone looks like they're going to buy this property, and I'm not in any way saying they're dumb. This is the right property for them, in the right condition, in the right neighborhood, and God bless them. That's great. It's the right thing to do. But yeah, I mean, to answer your question, of course, that's the whole idea, is take 2 spreadsheets and compare the numbers. That's why you listen to webinars like this, to learn how to do that kind of basic work.
So another question from Heidi. She says, earlier you mentioned that loans were different for commercial properties. Is the percent down required larger for commercial, and is there a recommended down payment to get the best interest rate?
Yeah, great question. So the funny part is, you know, 10 years ago, before we went into the downturn, it was very different. You could buy like single family condos or townhomes non-owner occupied for 5% down, but to buy a multi-unit, you had to put 20 or 25% down. So the answer then would have been, yeah, you know, like buy those little condos and townhomes and houses because you have to put so little money down. Well, that changed after the crash. And now, basically, you have to put 20% down for a normal loan on a single family or a condo or townhome. You can get away with 15%, but the terms suck. And 20 to 25% is normal, and same thing for the multis. So it used to be a big advantage of singles back in the day when you could put less money down. Now you're actually putting roughly the same amount down. And yes, no matter what loan, the more you put down, the better the terms are going to be. Just pretend you're the bank with $1 billion and you're smart. You want to reduce your risk. If the person puts more money on the table, you'll give them better terms. Any other questions, Chris, or getting close to wrapping up?
I think we're getting close to wrapping up, but a few more questions might be filtering in here. So if we still got about 5 minutes left, guys. Any questions, throw them in there. But there was something that I wanted to cover before we left, Charles. Oh, you've got the Investor Success Summit coming up in about 2 weeks. What's the deal with that?
So about 7.5 years ago, me and my buddies at Pine Financial just sat down and said, you know, we do lots of 1 or 2 hour classes. Let's do something bigger. Let's do an actual full day of training that people will love, that we won't sell anything, that we don't charge much. So this is our 15th. We do it every 6 months, Investor Success Summit. It's Saturday, October 28th, starts at 8:30 in the morning. Obviously, email us if you want more information. It's a total of $19 for the entire day, and believe it or not, we buy you drinks at the end of the day and hang out with you. And it's just a great series of classes. We have 2 panels. One of the panels is going to be on raising private funds. We have a bunch of us speaking, just experts from around town. I know Lon Welsh and Greg Parham are going to be speaking about fix and flips, looking at the numbers. I'm going to be doing a Metro Denver real estate trends and front range discussion, talking about the market. And we just get experts, people that we know, that we trust. No books and tapes. Nobody sells anything. We just get to talk about this stuff and meet more people. So definitely come. If you haven't, I think you'll enjoy it. We get great feedback, and the $19 just covers our costs. We have coffee and we have drinks at the end, and you'll just get to meet a lot of people. So if you're an agent, and I don't care what company you're at, come. It's open to everybody. This is what you should be doing once in a while. And if you're a client, I think there's lots and lots of things you can learn. And if you do come up and say hi. I'd love to say hello to you.
And all the details are at www.denveriss.com. That's ISS as Investor Success Summit. Details and the $20 registration page is up there as well. So I don't see any more questions rolling in here, and it's just at the end of the hour. So we'll start wrapping up. If anyone out there has any questions on looking at properties or wants to compare properties, reach out to us. I mean, I love doing this stuff, and Charles really loves doing this stuff, and I mean, obviously knows the numbers. So definitely reach out to us. All the contact details are at denverinvestmentrealestate.com. And Charles, thank you for coming out. I hope everyone out there appreciated your time. I certainly did, and I learned quite a few things as well. So thank you. I appreciate it.
Thank you, everybody. Thank you, Chris.
Have a great day, everyone. Bye-bye.